Let's review a modern portfolio theory. We're going to talk about the mean variance model and dominance principle, and then we will express every stock in terms of mean variance. And each stock is going to be expressed as a 1 point in investors' mean variance opportunity set. And think about which stocks to invest using so-called efficient frontier. Up to this point, we just think about the portfolio choice using risky asset. Then we're going to introduce risk-free asset like a US Treasury bill in the portfolio choice and think about how to form a portfolio in that environment using Tobin separation principle. And as a result, we're going to get capital market lines, so-called CML. And then based on this CML, Sharpe developed a very useful statistical model called market model. And we're going to use that model to think about systematic risk and idiosyncratic risk in any portfolio. A good reference on modern portfolio theory is Bodie K. Marcus Investment Chapter 7 and 8 in 9th editions or corresponding chapters on other editions. If you are fine with the every material in my slide, then you may not have to read this reference. And if you have any questions on this slide, you can ask your questions on discussion board. Let's say somehow you know expected return, expected variance, expected covariance for all financial asset. Financial asset means it could be stock, bond, anything traded in financial market. But in this class, we're gonna fix our attentions on stock. So here we're talking about stock investment. Let's say these information are given to you. Even in that case, it's not clear which financial asset you need to invest. So this is the question Markowitz asked in his PhD dissertations, and he introduced this concept mean variance model and dominance principle. Because of this principle, we can develop how investors should invest. So that's what we are going to review. Now, in practice, if you don't have good forecasting model, and if you think future behavior is similar to what you observed in the past, you can use historical data to compute mean for each stock, variance and covariance, and use this as an input to your portfolio choice. Now, in actual financial market, people are trying to get the better input to portfolio choice theory. So they want to develop a model for the expected return, variance, and covariance. We're going to assume here the future is going to be similar to the past, and we can use the past historical data to compute mean and variance and covariance. We're going to first think about portfolio choice between different risk assets, and then with the risk-free rate, and then we're going to talk about efficient frontier. So what is the mean variance model? Based on the historical data, we can compute mean and variance for and covariance for all the stock. For example, we have 3 stock here, ATW, GAC, FTL. So expected return for the future, we compute this number from the past historical data. Let's say the average return from historical data for ATW is 7%. GAC 7%, 3%, and we compute the standard deviations for ATW, GAC, FTL using historical data. Now, Markowitz says, given these informations, investor can choose certain stock based on the mean variance. For example, if you compare ATW and GAC, you see same expected return for both stock, but in terms of standard deviations, in terms of risk, ATW has a lower risk. If you have these informations and if you think the future is going to be similar to the past, then you will choose ATW over GAC. So ATW will dominate GAC. Now if you compare the ATW with FTL, now standard deviation is same, so same risk, but you expect bigger return from investing into ATW. Again, if you think the future is going to be same as the past, then you're going to choose ATW. That's the dominance principle. So once we have mean and variance using historical data, you can choose which stock to invest based on mean and variance. So formally, it says that investors prefer a higher expected return to lower returns given same variance or same standard deviations. Now, investors dislike risk. So they prefer a stock with the low variance and low standard deviations given the means are same across 2 different stocks. So we just apply that principle to choose ATW as the best one. And then Markovitch think about the actual investment behavior, and he found that investors are actually investing into a portfolio, not just into a one stock. So in reality, investors hold a broad portfolio of many securities, and you may have heard about this one. You shouldn't put all of your eggs in one basket. If you drop the basket, all eggs break. So these are actual investors' behavior. Why investors prefer to diversify? Is this consistent with the mean variance model developed by Markovitch and dominance principle? Markovitch says, yes, we can actually understand these portfolio diversifications using mean variance principle. The answer is investor can reduce risk by spreading the funds invested across many securities. What is the essence of this argument? We have to think about the correlations and covariance. So what is the correlation coefficient? It's a measure of the extent that two variables move or vary together. It ranges between -1 and 1. You need to know the meaning of this number. Positive correlations means a high value on one variable is associated with the high value on the other. So that is the meaning of positive correlations. Negative correlation means high value of one variable is associated with the low value on the other variable. No correlation means value of each are independent of the others. How diversification reduces risk? Why investing into portfolio is better than investing into one stock? Combining stocks into portfolio reduces the variability of portfolio returns. As long as the return on the individual stocks included in the portfolio are not perfectly correlated, which means correlation is equal to 1. Let's use an example. Let's fix the portfolio weight. So we just put 50% in stock A and 50% in stock B. So two stock case and fix the portfolio weight, and we're gonna vary correlations. Stock A, the mean is 13%, standard deviation is 20%, the variance is 400, 13, 20, 400, they look same in terms of mean and standard deviations. What is the expected return of the 50-50 portfolio? So expected return of RP, here P stands for portfolio, the weight on the RA, 50% times 13%, 50% times 13%, so 13%. What about the variance? This is variance formula, squared weight times variance of stock A plus squared weight to stock B, and the variance of stock B plus 2 times weight on A, weight on B, and correlations between A and B, and standard deviations of A, standard deviations of B. We can just plug in 0.5 square here, 400, 0.5 square, 400, 0.5, 0.5, and standard deviations 20%, 20%. So only one input, unknown input, is the correlations. Let's vary correlations from 1 to 0 to -1. If we use correlation 1, and the portfolio variance will be 400, which is same as the variance of the stock A and stock B, there's no risk reductions in this portfolio in this case. What about zero correlations? Now portfolio variance is just 200, just half of the variance of the each stock. So we have reductions of risk by forming a portfolio. So in this case, it's better to invest into this portfolio rather than invest into either stock A only or stock B only. Now in the extreme case, when there is a perfect negative correlations between A and B, portfolio variance becomes 0. So risk-free portfolio gives you same returns. So obviously by forming a portfolio based on the correlations, we can reduce variance of portfolio a lot, and this portfolio dominates each stock in terms of lower variance, in terms of dominance principle. We just talk about the fixed portfolio weight and two asset case. We can extend the above framework to the case of portfolio with a large number of assets. And in forming each portfolio, we can vary the number of assets inside the portfolio, and we can decide which one should be inside the portfolio, identity of the asset, and we can vary the portfolio weight to each asset inside the portfolio. Now, given the mean and variance and covariance and given the benefit of portfolio diversifications, which portfolio we must invest? In order to answer these questions, I'm going to use a graph and dominance principle. Once we compute expected mean and standard deviation of a portfolio or individual asset using historical data, we can express each stock as a one point in this graph. For example, this point is a stock with this mean and standard deviations. Likewise, every dot in this graph means a stock with the pair of mean and standard deviations. That is the step 1 of the forming portfolio. In step 2, we're thinking about forming a portfolio using individual dot in this graph. So Markowitz solved a mathematical problem, minimization problems. Intuitively speaking, let's say we fix the mean of the portfolio returns. You want to obtain 20% return in the future. And we're trying to form a portfolio achieving that with minimal variance. So there's a different way of getting 20% return in the future based on the portfolio weight. We can put 20% to this one, 30% to this one, 50% to this one, or we can put different weight to different point to achieve 20% returns. There are many different ways of forming a portfolio achieving this one. We're gonna try to find out the one with the minimum portfolio variance. So given each mean, we can solve this minimization problem to get the portfolio with the minimum portfolio variance. That is the meaning of this point. So once we change our target mean rate, let's say decrease 20% by 0.01 many times, for each level, we're gonna solve the minimization problem again, trying to achieve the minimum variance. So each problems will give you 1 point in this curve. That's how Markowitz obtained this curve in this graph. Now, if you are interested, I post an Excel file, instructions explaining how we can solve these minimization problems in the Excel using the historical mean and standard deviations and covariance. It's not for the exam, and I think you already learned that in your previous investment class. I just post that as additional informations in case you are interested in reviewing how to do that. So once we get this curve, we have to ask the question again. Which asset you want to invest? In this graph, we know the each point means a stock. And by forming a portfolio, we can get this curve. But this graph doesn't answer which assets to invest. Markowitz solved that issue by using dominance principle, mean variance dominance principle. He introduced this concept called efficient portfolio. What is it? If no other portfolio with the same expected return has low risk, or no other portfolio with the same risk has a higher expected return. This is just applications of mean variance dominance principle. In this case, we can call this portfolio as an efficient portfolio. Now, investors prefer efficient portfolio over inefficient one because of the mean variance dominance principle. The collection of efficient portfolio is called an efficient frontier. Let's go back to this graph. I'm gonna draw the horizontal line. I'm gonna say this is the upper curve, this is the lower curve, and the point where you have minimum standard deviations, I'm gonna call this as the portfolio with globally minimized portfolio variance, global minimum variance portfolio. And we can think about this upper part of this curve. Any point in this curve dominate any point below this frontier. Why? We're gonna take a look at that more precisely next slide. So let's take a look at only the upper part of the curve we just saw in the graph. It's the same mean and standard deviation of a portfolio. And let's compare the point on this efficient frontier against the other dot inside this frontier. So for example, compare any point here with the any point below. By dominance principle, this point dominates everything below. Same standard deviations, but this one has a higher returns. What about A here? Comparing this one against any point here, it has same expected return, 90 degree, but this guy has a smallest standard deviations. So by using dominance principle, we can conclude that investors should invest only in this dot on the upper curve, but not inside the curve or lower curve. This is the set of portfolio investors need to choose. That is the main result of the Markowitz portfolio diversification paper. Here, we only use risky asset. There's no asset with zero standard deviations. So this is true for risky asset case. And each investor can choose different point in this efficient frontier. You can choose this one or you can choose this one. Based on each one's preference on the mean and standard deviations, each investor can choose any point in this efficient frontier. That is the result from Markowitz portfolio choice. Now we're going to introduce risk-free asset in this graph, and things will be much simplified by doing so. James Tobin got the Nobel Prize. One of his contributions is about the portfolio choice, so-called separation theorem. Once we introduce the risk-free asset in this investment opportunity set, then all investors prefer to hold a combinations of the risk-free asset, US Treasury bill, and market portfolio. Such combinations dominate all other asset and portfolio in terms of mean variance dominance principle. We're going to take a look at graph called capital market line in the next slide. Let's look at this pink point here. It has zero standard deviations. So this is risk-free asset with this return, risk-free return. Once we introduce risk-free asset, we can think about portfolio choice again. We're going to form a portfolio of risk-free asset and one risky asset. What is the portfolio using those two assets? Well, for example, if we want to form a portfolio of risk-free asset and this one, you can just draw a line, and any point in this line stands for a portfolio of risk-free asset and that risky asset. Why we have so many different points in this line? For example, this one stands for a portfolio where you put 50% to risk-free asset and 50% to this asset. What I'm saying is each point means different portfolio weight to risk-free asset and risky asset. Now, Tobin defined the market portfolio. So what is market portfolio? We're going to talk about that later on. Let's say there's one market portfolio. And let's form a portfolio of risk-free asset and that market portfolio. And we can draw a line like this. And what is the meaning of this point in this line segment? It means you put certain percent of your wealth into risk-free asset, like a 40 to risk-free asset, 60 to market portfolio. So this is a form of portfolio with that portfolio weight. What about the point in this line segment? It means you borrow at risk-free rate and you leverage your stock market investment. Something like you borrow 20% at risk-free rate and you put 120% of your wealth into stock market investment. So these are leveraged investment and these are portfolio of putting some money to risk-free asset. Once you draw this line, form this portfolio, any point in this line dominate all other points below that line. In terms of mean variance criterion, any point in this line dominate all other choices. So you can just draw a line vertically, so 90 degree, any point in this line dominate everything below. So this is Tobin's separation theorem. In terms of risky asset, everyone should invest into a same portfolio, market portfolio. And then in step 2, each investor will choose a different portfolio of risk-free asset and market portfolio. Let's say you are a risk-averse investor. Then you want to put more wealth into risk-free asset. Or let's say you are a less risk-averse investor. You want to borrow from the bank at lower interest rate and you want to leverage your stock market investment. So your choice will be in this line segment if you are less risk-averse guy. Now you may be wondering why we have straight line when we think about portfolio using risk-free asset and risky asset. I'm going to just give you an answer because there's no standard deviations for risk-free asset. If you form a portfolio using risk-free asset and risky asset, the portfolio standard deviation will be just coming from risky asset part. If you put more wealth into risky asset, that will increase portfolio variance proportionally. depending upon how much wealth you're gonna put into risky asset, will be just linearly increasing. Anyway, we call this line as a capital market line, and all investors need to choose a point in this line. In summary, Tobin separation theorem tells us all investors need to choose market portfolio as their risky stock market investment, and all investors will have different portfolio of risk-free asset and market portfolio according to their risk preference. This is very striking result. If we apply this one in the usual practice, this means every investor need to hold something called market portfolio in their risky stock market investment. What is the market portfolio? It consists of all risky assets in financial market. All risky asset means you have to include bond or stock or any risky asset traded in financial market. But in practice, when we talk about the market portfolio, it's normally stock market portfolio. So we're going to focus on stock case. In practice, we often use stock market index as an empirical proxy for market portfolio. For example, in US, we use S&P 500 index, and for the world market portfolio, we use Morgan Stanley World Market Index. And actually, you can buy and sell the market portfolio easily nowadays. For example, in US, there's an ETF on the S&P 500 index. So if you buy that ETF, the mean and standard deviations of that ETF will follow mean and standard deviations of S&P 500. Based on the capital market line, William Sharpe developed a very useful statistical model called market model. This model is closely related to the CAPM. So market model assumes that the return on each asset is equal to intercept. Here I means intercept specific to this company I. So this is constant. There's no variation for this one, constant. This is the CAPM beta I on this company I. And RM is the return on market portfolio. And epsilon I is the idiosyncratic return to this company I. Let's think about stock investment. You buy a stock at T-1 and you sell that stock at time T. And we can compute holding period returns. This is the holding period return for time T. You buy at T-1 and sell at time T. And that return is going to be decomposed as intercept plus beta i's times market returns plus idiosyncratic returns. So let's say you have 10% return here. And let's say this is 0. And why you got 10% realized returns? Because market moved like a 5%. If the beta of your company is 1, then 5% is independent from market movement. And our interpretation is you obtain 10% return because the market went up by 5%, and because your company's beta is equal to 1, you get 5% return from market movement. But in addition to that, there was a really good news to this company which has no correlations with market movement, something like your company developed a new drug, something very important. And because of that, there was a 5% return from idiosyncratic event. So the common market return and idiosyncratic movement, EI, are the two sources of the period to period, for example, day-to-day fluctuations in the security I's returns. And we can always explain realized return in terms of these two movements. Be careful, idiosyncratic term is uncorrelated with the market. And most case, we're going to assume that idiosyncratic return for I has very low or zero correlations with the idiosyncratic term of other securities. That is the meaning of idiosyncratic term. Let's think about market model for two securities, security A and security B. RA is equal to alpha A constant plus beta of that company, market return, and idiosyncratic movement of that company. We have same specifications for company B. What is the source of the covariance between A and B? Now alpha A and alpha B is a constant, so there's no variations. So these are not the source of common variations. And we assume that this is idiosyncratic term. Covariance between this and this will be close to 0, approximately 0. So why there is a common movement? Because of the common market movement inside. So RA increase, RB increase if the beta A is equal to 1, beta B is equal to 0.5, and when the market goes up, both goes up because of this market movement. Why they went up differently? Because of different beta, right? So we have statistical descriptions of two companies, common movement and idiosyncratic movement. Let's talk about market model for portfolio. Let's say we combine A and B to form a portfolio, and we call that as RP. Then what is going to be RP? It's a weighted average of the each asset. So in terms of two asset case, will be WARA plus WBRB. And then we can plug in market model for RA and market model for RB. Then we can compute the market model for portfolio P. So alpha P is going to be weighted average of the each asset's constant, and beta P is going to be weighted average of the each company's beta, and we have market portfolio returns and weighted average of each company's idiosyncratic terms. That's the epsilon P. Let's compute variance of this portfolio. So if you compute variance, first of all, this is constant, so variance is equal to 0. And you know the variance formula, variance x plus y. This is equal to variance x plus variance y plus covariance. Now, there is a zero correlation between market movement and idiosyncratic movement because that's the very name of the idiosyncratic term means, specific to this asset only. So covariance is equal to 0. Variance of portfolio return is equal to variance of beta P RM plus variance of the EP. And we call this, the first term, variance related to the market movement as a systematic risk. And we call this variance of the weighted average of idiosyncratic term as idiosyncratic risk of this portfolio. And by forming a portfolio, we can actually deduce variance here, because we assume for simplicity almost zero correlations between idiosyncratic term in A and idiosyncratic term in B. The variance of the idiosyncratic term is not the weighted sum of the securities' idiosyncratic variance. Because of zero covariance, you can reduce variance in this term. Recall the two asset portfolio example with less than 1 correlations. We could diversify idiosyncratic risk of portfolio. In sum, a story of portfolio diversifications using the market model. Since the securities' idiosyncratic terms are largely uncorrelated, almost zero correlated, they tend to diversify when you include all of the security in your portfolio. With a sufficiently large, well-diversified portfolio, in other words, by mixing many risky assets, the variance of portfolio's idiosyncratic term is going to be negligible. It's going to be close to 0. This is the most important benefit of portfolio diversifications. By forming a portfolio, you're going to reduce this idiosyncratic risk. This is not true of the variance due to what is called the systematic risk or non-diversifiable risk. It is coming from the same source of the common movement, so you cannot reduce a risk coming from this part. Before, we didn't differentiate systematic and idiosyncratic risk. We just talk about the benefit of the low correlations at the time. But in real practice, by forming a portfolio, what we are removing is actually the idiosyncratic risk.